Okay, so welcome once again to auditing and internal review. We'll continue from where we stopped. The last time we stopped at lecture 2, we looked at the definition of auditing. We look at the definition in detail, each of the elements of auditing. What do we mean by a qualified appointed person? We looked at the audit process. We looked at what does the definition means by records and financial statements. We also looked at independent examination. We also looked at the opinion. What do we mean by true and fair and all of that? So we actually look at quite a lot of important things. So I think we look at what an audit involves. I think we stop at the objective of an audit. And we say the objective of an audit is for the auditor to express an opinion. So I think this is where we stopped. So now today we'll continue from the distinction between statutory audit and non-statutory audit. But before that, let me ask, do you have any questions from the previous 2 classes? Or you have a contribution to make? Do you have a question, contribution? Anyone, please? Okay, if there are no questions, no contribution, I think we can continue. Please, when we say statutory audits and non-statutory audits, what comes to your mind? What do you think it entails? In fact, what do you understand by the word statutory? Something that is based on statute. What does it mean? Anyone, please.
Is it backed by law?
Okay, great. Great. So statutory means it is backed by law or it is derived from a specific set of laws. Okay. So we have two main types of audits. We have audit that is backed by law and audit that is not backed by law. So we say in most countries, audits are required under national statutes for many undertakings, including limited liability companies. Other organizations and entities require a statutory audit may include charities, investment businesses, trade unions, etc., etc. But we are interested in the Ghanaian case. What does the Ghanaian case say? We say in Ghana, for example, under registered companies legislation, we are making reference to the Companies Act. Please, this act has been amended. This is not the new Companies Act. There's a new Companies Act now. That's Act what?
2019.
Act 21 what?
92.
192 or 912? Which is which, please?
192.
Hey, are you sure? 192. No, it cannot be 192. As for 20, you said at 2019, right? As for the 2019, that is correct, but the 192, I doubt. Please check it out again. Please, that
992.
act, come again.
992.
992, great. Please, that act is very, very important for this class because that's what we are going to be using throughout this class. Remember, Auditing in itself. Okay. So I noticed that I drop off a bit. Auditing in itself is backed by law. So in this auditing class, our focus will be on that Act 992 of 2019. That's the Company Act. In that act, there's a requirement that most companies are required to be audited. In fact, the act has even stretched the argument that listed companies are supposed to publish their audited financial statements every year. And someone may ask, what do we mean by listed companies? Who can tell us what is a listed company? Or which companies are referred to as listed companies?
Please, can I try?
Yes, you can try.
Okay. Is that
Let me see who is trying. Let me
that
get
is
your name. Sam. Okay, yes, Sam, take it.
is it companies that have their names published in the is it s- stock exchange register?
Okay, that's a good try. Okay, Veronica Vero has gotten it correct. So companies that are listed on the stock exchange, they are the ones we refer to as listed companies. Or in other words, these are public companies. Once a company gets listed, it means the company is no longer a private company, but it is what? A public company. That is to say, anyone can invest in it. So, for example, MTN. MTN is a listed company. GCB Bank is a listed company. Cow Bank is a listed company. Guinness Ghana is a listed company. Fan Milk is a listed company. So all these companies I just listed, they are called what? Listed company. So the Companies Act require that these companies, they must be audited every year. And not only that, but they must publish their financial statement. If it is a private company, they must be also audited every year, but they are not required to publish their financial statement. That's the difference between listed companies and non-listed company. And who can tell me what's the reason why you think a listed company is supposed to publish their financial statement? Anyone can give it a try. Why would listed company be required to publish their financial statement, whilst non-listed companies are not required? Anyone? Anyone can give a try. Okay, well, the reason is that because these listed companies, they are companies that anyone can invest into them. So you can buy shares. Once you follow the right procedures, anyone can buy shares. Therefore, it means that these companies, they are exposed in a way to certain conditions within the economy, just like every company. However, these listed companies, because of what the interest, there's a public interest in them. Therefore, because of that public interest, transparency and accountability becomes what? Of a higher threshold as compared to a private company. Because once the company is listed, people are investing their money in it. People need to know what actually is going on, whether the company is doing well or not. That's why you see every year GCB Bank, they will announce the amount of profits they made, how much they've given to their shareholders as dividends and all of that. It's because of this was requirement of the law. Do you think there are advantages for a company to be audited? Yes, there are several advantages. One of the advantages is that it gives the entity the benefit that you have professionals, because normally those who audit the company's accounts are what? Professional accountants. In the case of Ghana, we say they are what? Chartered accountants. So you can imagine a chartered accountant reviewing your account as compared to a normal accountant. You can see that there will be huge what? Difference. So once companies get audited, they receive this kind of what? Benefit, that their accounts are being what? Audited or reviewed by a professional. The second benefit is that recommendations can be made by these professionals to the entity in terms of how their internal control processes can be enhanced, their accounting policies, their accounting systems, and all of that. So these professionals, when they come to audit, they don't just audit and go like that too. They give recommendations, and these recommendations are meant to what? Ensure that the accounting systems that the entity is using, those accounting systems are what? Actually enhanced. So that's one of the advantages of being what? Audited. So what about non-statutory audits? So we say for non-statutory audits, they are performed by independent auditors, just like statutory audits. But why are they performed by independent auditors? Because the company owners, members, trustees, or governing bodies or interested parties want them to be audited. Rather, there's a requirement of the law. So in this case, there's no requirement in the law that states that non-statutory companies should be audited. But because of accountability, transparency, and the rest, these companies will want to be audited so that at the end of the day, whatever accounts they bring out, those accounts can be what? Trusted, or those accounts can be what? Credible. So because of that, they will also prefer to be what? Audited, even though there is no legal requirement for them to be what? Audited. So if this is the case, then it means auditing in itself can span to different forms of entities. So a church can be audited, a charity can be audited, a private school can be audited, a public organization can. So practically almost everything can be audited. So almost everything can be audited. Good, 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 good. Please, any question? Any
No,
question at this point? Yes. I think someone was trying to ask a question.
no, I said no, please.
Okay, great. Then we move to our next subtopic, which is audit expectation gap. Audit expectation gap. First of all, let me explain what is a gap. Then I will like join the two together. So, what is an expectation first? An expectation is an intent or is something that someone wish someone achieved. So, for example, if you write a paper, maybe your expectation is that this paper you have written there, Charlie, I'll get an A in this paper. That's your expectation. However, when the results came, you got a D in that paper. So therefore, it means your expectations has not been met. Okay. So let's now join that to what? Auditing. When we say audit expectation gap, we are simply saying is that gap that exists wherein people from the outside world, how those people view auditing to be like, and how auditing actually is. So, for example, someone may view auditing as a process for the auditors to catch thieves, detect fraud, and the rest. That could be the person who has mindset about auditing. But at least from our first, second, and today's our third class, we all agree that that's not the objective of the auditor. That's not the aim of the auditor. So right there, there's what? An audit expectation gap. Someone is expecting the auditor to catch thieves and criminals. But in actual sense, the auditor is not there to catch thieves and criminals. Therefore, there's what? An expectation gap between the two parties. So we say an expectation gap is defined as the difference between what the public expects from an audit and what the audit profession accepts the audit objective to be. So what people think that an audit is and what actually an audit is. So that forms part of what we call what? An audit expectation gap. So these are some of the examples of audit expectation gap. Please learn these expectation gaps very well. It comes in the midterm and exams a lot. So what are some of the expectation gaps? One, I want for someone to read the first one.
Auditors should accept prime responsibility for the financial statements.
Okay. What do you think about it? Did you have that thought before? That as for auditors there, they are responsible for the financial statement.
No,
Hey, you never had that thought.
no.
Any other person here? Okay, let's read the second one.
Should I continue?
Yes, please. The second one, please continue.
Please, with the first one, I was thinking is the management, those in question that are responsible for the financial statement. So the auditor is only coming to check or verify if they did everything according to what is supposed to be done. So it's not their main responsibility, it's the management's responsibility.
Exactly. So that's why it is an expectation gap because some people, when the auditors come to audit, they think that it's the auditor who is responsible for the financial statement. You see, when the auditor writes his reports, the audit opinion, you know that normally when you go to the banks, whenever you go to a bank, just be a bit curious. Normally, they publish their financial statement and they also publish their auditors reports. You can see that the auditors report and the financial statement, they are always together. So some people think that because they are always together, it is the auditor who is responsible for the financial statement. That's why we say why it is an expectation gap, but in actual sense, the auditor is not responsible. So then my question now is, who is responsible for the financial statement? Who is responsible for the financial statement?
Is it the accountant?
No. The accountant is not responsible for the financial statement. Even though it is the accountant who prepares the financial statement, but who is responsible? Who does the bus stop at?
I think the board of directors.
Say again.
The board of directors.
The board of directors. Okay, that's a good try. I will accept that. But it's not even really the board of directors. It is management. Mm? Management is the one responsible for the financial statement. Management. Okay. Okay. Let's move to the second expectation gap. What's the second expectation gap?
Auditors certify financial statements.
Great. What's your take on that?
Okay, so with this one, I think I agree with them. But initially, like you said, people normally think they are coming to detect fraud and stuff, but then their duty is to make sure that the financial statement that is prepared is of what is required. Yeah, so they put some credibility on the financial statement.
So you are saying auditors certify their financials. Do you understand the meaning of certified? If I give you a certificate of, let's say, um, a certificate of achievement, do you understand what a certificate is? Do you understand what it means to certify something?
Yeah, to put a seal or something on it to show that this thing has been checked, it has been looked at.
Exactly. So, to you, in your opinion, you think auditors certify financial statements, right?
Yeah, that's what I'm saying. Initially, we know them to be just coming to detect fraud, but then their main work now is to certify, like put some credibility on the statement.
Okay. So you're also part of the group. This is not true. Auditors do not certify financial statements. Understand the word certified, and you even define it nicely. You said to put a seal on it. They don't sign and seal the financial statement. It means you are saying that auditors are saying that everything in the financial statement is correct. Nope. That's an expectation gaps. Auditors don't do that. They don't certify it. They audit and they give opinion. To certify means you are 100% correct. And there's a reason why auditors don't certify it. That point is at point 4. But let's go to point 3. Can you read point 3? What's the third expectation gap?
A clean or unmodified opinion guarantees the accuracy of financial statements.
Okay. Anyone, what's your opinion on this? A clean opinion, that is to say, if the auditor says that the financial statement shows a true and fair view, does it guarantee that the financial statement in itself is accurate? Some people think that when the auditor says that the financial statement shows a true and fair view, it means the financial statement is accurate. What do you think about that? Anyone? We are having a conversation. I like to have a conversation at this particular side so that you get the understanding properly. So what do you think, friends?
Okay.
Do the
So
auditors, when he
per
gives
the
that
first
opinion
two,
that, yes,
per the first two, I would say no. For the third,
for the third, come again.
I would say no. The auditor doesn't certify. The auditor doesn't give a clean opinion
Oh no, he
guarantee.
gives so. When we start looking at audit opinion, we have three main types of audit, two main types of audit opinion. We have unmodified audit opinion and modified audit opinion. So the unmodified one is the clean one. That is where the auditor says the financial statement shows a true and fair view, meaning it is clean. Proper books of accounts has been kept, everything is okay and all of that. But we are saying that when the auditor gives that opinion, does it guarantee, the word there is guarantee, does it guarantee that the financial statement is accurate? What is the meaning of accuracy or accurate? Meaning there are no errors. Is that not so?
Yes.
It is correct. Does it guarantee that the financial statement doesn't have error, even though he has given a clean opinion that it shows a true and fair view? No, he doesn't. So this is another expectation gap. He doesn't guarantee that the financial statement is accurate. He doesn't guarantee that. A guarantee is a firm commitment, a commitment that is unshaken. So, for example, if a guy likes a lady, in order for the guy to guarantee the lady's love, what do you think he would do? Hmm? Oh, hello. If a brother likes a lady, if he wants to guarantee the love with the lady, what do you think he would do?
You give him promise ring.
Oh, my brother, what is promise ring? Someone should help our brother. As for promise ring, there, it's just promise.
Achemu.
What do you think the brother would do? Let me ask you, good. If you like a girl and you want to guarantee your love with a girl, what will you do? Hey, this is straightforward, though.
Is it
Okay.
marriage or
Of course, it's marriage. What else? Ah, how can you say you like someone and you cannot marry the person? Like, how is that possible? Meaning you cannot guarantee the person's love. The person shouldn't even waste their time with you. Hmm?
oh, it will start from somewhere. So you like the
Oh,
person.
my brother, my brother, my brother. We've passed that stage where the thing it has started. This one there it has established, not even started. It has been established. So to make the thing hold, you have to get married. Is that not so? If
Sure.
you know that you don't want to get married to the person, it means the love is not guaranteed. That's what it simply means. Okay, my fourth point. Okay, please read the fourth point. Fourth gap.
Auditors perform 100% check.
What do you think about it?
They don't do 100%.
Hey, are you sure? The auditors, they do lots of work. Are you sure they don't do 100% check? Yes, auditors don't do 100% check. So some people think that auditors do 100% check. That's why some people are saying that the auditors certify the financial statement because some people think that the auditor do 100% check. which is not accurate. He doesn't do 100% check. He doesn't do 100% check. Okay. I love this point. Auditors should give warning about the possibility of business failure and auditors are supposed to detect fraud. And there's a journal here, Wisconsin Law Journal article entitled "Why Didn't Our Auditors Find the Fraud?" So do you think that auditors are supposed to give you warning that, hey, this business will collapse, or this business, like the possibility of the business failing? Are they supposed to give you those early warning? No, it's an expectation gap. Are they supposed to detect fraud? Are they the ones supposed to detect fraud? No. Who is responsible for detection of fraud? Who is responsible to detect fraud?
Management themselves.
Management. Great. So that's not the auditor's responsibility. Okay. Please, any questions on the expectation gaps? We are not done yet. There's even more. Some people also think that the auditors report to the directors of the company, but not members. This is an expectation gaps. The auditors do not report to the directors. They report to members. That's the shareholders. They are the ones the auditors report to. A modified audit report is more useful to those who appoint the auditors than unmodified reports. So modified report, this is where the auditors will be like, oh, this, and this were some of the issues we were able to like fish out. So that's a modified report. Some people think that modified audit report is more useful or more important to the auditors. And then also, there's the misconception that the auditor's duty to detect fraud. Okay, we've explained this one already. Okay, good. Any question on the expectation gaps? Any questions on the expectation gap? Okay, let me ask this question. Is there a need to conduct audits? Is there a need to conduct audits?
I think yes.
Okay. But some people think there's no need to conduct an audit too, because after all, you have an accountant who is there preparing the books. You have an internal auditor. So what's the need of appointing an auditor? There's some school of thought. That's so why are we paying the accountants? Why are we paying the internal auditors? So there's no need to conduct an audit. That's some people's opinion. So there's a reason or there's a need for an audit. The need for an audit is that because of separation of ownership and management, okay, management is different from those who owns the company. Therefore, since those who owns the company, they are not the ones who manage it. The owners of the company will always want to know whether management is working in their best interest. And how can you know this? You are not always at the premises of the business. So you cannot know. Some of them, someone has bought shares in MTN and the person is in Tamale. How would the person know how MTN is, the managers of MTN, how they are managing their funds? They wouldn't know. Okay. Because the person cannot leave Tamale and come to Accra to be seeing what managers are doing. The only way they can do that is through an independent person. And that independent person is the auditor. So, because of that, there's a need for an audit. And we are saying that this person who is an independent person comes to perform an examination. And that examination in itself is supposed to report back to the owners that one, the financial statement is not misleading. Two, the financial statement does not contain misstatements, that's errors and fraud. And whether management has disclosed all the relevant information that they are supposed to disclose. This cannot be done by management. It can only be done by what? A third party. It's like yesterday, those of you who watch football match, Manchester United was playing Liverpool. By the way, I'm a United fan, a very big one. Manchester United was playing Liverpool. Okay. Manchester United cannot be the ref at the same time a player. Do you agree?
Yeah.
So therefore, we need an independent person, someone who is an outsider, to come and ref the game. If Manchester United was the ref at the same time they are playing, what do you think will happen? There will be chaos. There will be unfairness. There will be no objectivity. There will be no neutrality. So because of all of these issues, we need a third party person to come and what? Examine the books that management has prepared. Okay. And why are we doing all of this? This is to ensure that the financial statement that management has prepared is credible. And also remember, I told you that most of these shareholders, they are not in close vicinity of the business. Therefore, they don't know what is going on. However, for their interest to be protected, they will need a third party person coming to tell them that, oh, your company financial statements are in order. Once it is a third party, they are most likely to what? Believe that person. And not only that, another important reason for audit is that audit provides compliance with legal and regulatory requirements. When the auditors come to audit, they don't just audit the financial statement too. They will audit, for example, does the company has all the legal documents it needs to operate? Have they filed their taxes? Do they pay SNIT? Do they pay PAYE? All of these things will be checked by the auditors. Are they compliant with the company internal controls and all of that? All of this will be checked. And the reason why the auditors are checking all of this is that They want to reduce what we call what? Computer fraud. Computer fraud and all of that. Okay, great. Any questions on why there's a need for an audit? So today, if a friend from marketing department or HR asks you, you people, you always take money as auditors, and the person asks you, me, I didn't do accounting. Why should someone be audited? Why should my company be audited? I don't see the need. In fact, it's waste of money. I hope with what I just said, you should be able to convince the person.
Yes.
Okay. Can we proceed?
Sure.
So what is the scope of an audit of financial statement? When we say scope, what does an audit entails and what is excluded from an audit? So normally when we talk about the scope of an audit, we are referring to the audit procedures the auditors will use. And auditing, please be mindful, auditing is guided by standards. The same way how in accounting, financial accounting, you have IAS 1, you have IAS 2, you have IFRS 15, you have IAS 16, you have all those standards in accounting. Same way, in auditing too, we have our standards. In fact, we have over 25 standards in auditing. And by the end of this auditing class, you have to learn all those 25 standards. They are examinable. All of them. Both first semester and second semester, you have to learn all of them. They are all examinable. All of them. So auditing is based on international standards on auditing. And we conduct audits based on the appropriate situation. And the objective of the auditor is to what? Express an opinion, as we saw earlier. So all of these issues forms part of what? The scope of an audit. The scope of an audit. Okay. So remember, I told you that auditing is based on standards. And on the international scene, we have what we call international standards on auditing. It's an internationally accepted standards. That's what everybody's supposed to follow. But locally too, we have our local standards. So we call it NSCs, National Standards on Auditing. National Standards on Auditing. National Standards on Auditing. And not only that, but they are relevant professional bodies. So in the case of Ghana, which professional bodies regulate the auditing profession?
Chartered accountants.
Please say again.
The Institute of Chartered Accountants.
Great. The Institute of Chartered Accountants, Ghana. So if you go to Nigeria, they also have their they call theirs ICANN, Institute of Chartered Accountants, Nigeria. When you go to other countries in Africa, in fact in the world, they have their own professional national body that regulates how the profession is supposed to what be practiced. And then not only that, we have legislations and regulations that govern the auditing profession. So in Ghana, we have what? The Companies Act, Act 992 of 2019. That's one. We also have the Public Financial Management Act, even though that one is more of accounting, but it also speaks about auditing. We have the Ghana Audits Service Act. We have the Internal Audit Agency Act. These are all acts that regulate the auditing profession in Ghana. Okay. Are there advantages of auditing? Let me ask. Do you think the advantages of auditing?
Yes.
Okay. Since you said yes, can you give me just one advantage of auditing?
It helps principals to know if management are not, or if agents are not working to their own interests.
Okay. Any other person? Addition. Any other person? Okay. So these are the advantages of auditing. It adds credibility to the financial statement because the person who is coming to audit the financial statement, that person is an independent outsider. Therefore, it adds credibility to the financial statement. It also assures that the stakeholders of the truth and fairness of the financial statement. Remember, at the end of the day, the auditors are coming to tell you whether the financial statement shows a true and fair view. So it assures the other stakeholders, that's employees, suppliers, shareholders, the banks, and all of that. It assures them that the financial statement shows a truth and fair view. It also avoids disputes among partners. So if there's any confusion, because the financial statements are audited, it minimizes this kind of what? Confusions and all of that. And most importantly, it serves as a reliable source of information for banks. See, these days when banks want to give you loans, they normally ask you to bring what? An audited financial statement. Because once the financial statement has been audited, the bank can easily use it as compared to one which hasn't been audited. So it is very important for you to get your financial statement to be audited. And not only that, it's even assessed in tax liability computation. So once your financial statement has been prepared, there's a likelihood that the tax authorities are what? Most likely to easily assess your tax liabilities. Oh, sorry. Okay. So what about the disadvantages of auditing? What do you think would be some of the disadvantages of auditing? What could be some of the disadvantages of auditing? A, are you guys in this class? We are 17 on the call and everybody is mute.
Yeah, yeah.
Please, the disadvantages of auditing, what do you think? Anyone, please. Okay. The very first one that comes to my mind is that audit is not a cheap exercise. Audits are very expensive. So you have to pay the auditors what to call what an audit fee. So that comes as what? As a burden, an additional financial burden. Maybe the company is not doing well, but the company is forced to what? Pay that burden of trying to pay for what? The audit in itself. So it comes as what? An extra burden. So another disadvantage of auditing is that, you see, when the auditors come to audit, normally the employees, especially those in the finance department, they are not able to do their own routine work because always the auditors will be requesting for documents. They need this, come and perform this. They will come and call them for interview, all of that. So because of that, they cause lots of what? Inconveniences whenever they are around. So this comes as what? A disadvantage of what? Auditing. Okay, please, any question? Okay, let's continue. So now let's look at the types of audits. What are the types of audits? So first, we say we have statutory audits and non-statutory audits. I think I've explained that. So let's look at a private audit. So with a private audit, it is one where the client doesn't really need to what, be audited based on law. However, the client has availed himself or herself to be audited. So in that case, we say what? It's a private audit.
Please come again.
Okay. I'm saying that with a private audit, there's no legal requirement for the audit to be conducted. Okay. However, maybe a partner or a a partner in the partnership, maybe any person who is connected to the entity may call for the entity to be audited. So that's why it is what? Friendly.
Okay, thank you.
Okay, great. So when it comes to the private audit, the scope of the audit is determined by the auditor and the client. So they determine which one of the books to audit, where to audit, and all of that. But in the case of a multinational company or something like that, the audit is done based on law. If it is a listed company, the Companies Act will dictate how the company is supposed to be audited. The procedures are all in there. So I've already explained what statutory audit is. It's an audit that is required by law. So in the case of Ghana, we talk about the Companies Act, Act 992. So when it comes to the statutory audit, the scope of the statutory audit is not determined by the people involved. It is already determined by law. So the law determines whether to the public audit or the statutory audit is conducted. The law determines it. So that will be the Companies Act. So if you read the Companies Act, it will tell you how the laws are supposed to be enacted. Sorry, how the audit is supposed to be conducted. So we also have external audit and internal audit. So with the external audit, this is where an independent person from another organization comes to the entity to audit. And this one we see them most of the time. And then for an internal auditor, this is where the organization appoints a full-time staff to monitor and report on the running of the company's operation. So that's for internal audit. So let's move now. Okay, there's a hand up. Yes, they're great.
Mr. Financial Derek.
Yes, sir.
Good evening.
Good evening, sir.
Please, I want you to help me understand this.
Okay.
There's this thing that bothers me sometimes, like the role of a monetary officer as compared to an auditor. But these two bodies confuses me sometimes. Someone who's been appointed as a monetary officer and someone who is being appointed as an auditor. Are they doing the same work, or can you please help me?
I think you have to come again with your question. I didn't get the last part.
I'm saying that I want
Mm-hmm.
you to help me understand the rules that have been played by a monetary officer as compared to an auditor. That's the question.
Oh, okay. Oh, first of all, I guess you are talking about an external auditor, not an internal auditor, right?
Yes, please.
Okay.
Okay. A supervising officer supervise work that is being carried out.
No,
Okay.
I'm saying a monetary officer.
Sorry, a monitoring officer. So
Yes.
an officer is someone who does what? Monitoring and evaluation, right?
Yes,
He
please.
checks, do lots of review based on that, write a report and all of that. That person is different from an auditor. An auditor is guided by standards. Okay. An auditor is guided by standards. And what the auditor does is that he examines the financial statement. But the monitoring officer, he may be monitoring different things, not just the financial statement. So they are not the same.
Okay. Thank you very much.
You're welcome. So let's look at the methods of auditing and then we call it a night. So the first method, we have complete audits. So let me just put this in a simple sense. Complete audit is where the auditor comes to audit at a go. So that's what normally happens to most of us at our workplaces. The auditor comes and audits for like 3 months, 4 months. Sorry, for like 3 weeks, 4 weeks, then he's done. That's a complete audit. So with a complete audit, the auditor comes, audits at a go, and that's it. He's done. That's why it is called what? Complete audit. And these are some of the advantages of the complete audit. It enables the auditor to plan more audits because once you are done, that's it. You can go and do additional audits. So the audit is done at a stretch. It avoids the need to return to uncompleted work. So when you are doing it, you do it thoroughly. And once you are done, you are done. So with this one, the audit is conducted at a stretch. And there's no need for the client to now making the auditor to be returning to uncompleted work. And because of this, the client cannot easily alter figures because the audit is done at a stretch. Okay, so that's for complete audit. What about some of the disadvantage? So if the audit firm is a small one, they may find it difficult to allocate other staff to all of their clients at a go. So let's look at the other method, interim audit. So with the interim audit, the auditor carries out the audit in bits and pieces. In bits and pieces. Okay. These are some of the advantages of continuous audits. So with the continuous audit, this is where the internal controls of the client are very weak. So the auditor has to be there all the time to check and see whether they are doing the right thing. So that's an example of a continuous audit. And the advantages are here, the disadvantages are also here. You can read that one by yourself. Okay. So we'll stop here for today. If you have any questions, please ask your questions now. Are there any questions, please? Contribution, concerns? Okay. So if there are no questions, then we'll bring the class to an end. Thank you very much for the time. We'll meet on the other side again.
Alright. Thank you very much. Really appreciate it.
Thank you very much.
Bye.
Bye bye. Have a good night.
You too. Bye.